Over the past 5 years, Broadcom is up by 467%, and over the past year, they are up just under 75%. And so in today's video, we will figure out if this huge rise in price is justified, and if Broadcom will keep rising over the next few months and years, or if it's unjustified and Broadcom will fall in price. And to do this, as always, we will use our stock valuation spreadsheet, where we'll have a look at the fundamental 9-pillar analysis and calculate the intrinsic value of Broadcom at the end of the video. Now, first of all, we have to plug in the ticker of Broadcom and wait for all the metrics to show up. Now, if you find these spreadsheets helpful, you can always download them at the link in the description. Now, first of all, we can see that Broadcom is a dividend company. They currently have a dividend yield of 1.19% with a dividend payout of $2.12 and a trailing free cash flow payout ratio of 44.84%. So it is getting quite close to the 50% mark, which would make me uncomfortable as Broadcom is in the technology sector and they have to direct a lot of their free cash flow into innovation. Now, another thing to look at is the difference between the market cap and the enterprise value. And the difference between these two is essentially debt. And so we can see that they have about $60 billion in debt, which isn't too much compared to their enterprise value, so I'm quite fine with it. But now let's jump to the 9-pillar analysis, and we can see that Broadcom gets a rating of 7 out of 9. We can see that their 5-year profit margin is sitting well above the 10% we like to see, sitting at 73.22%, which is great. And their long-term liabilities over the 5-year free cash flow negative dividends is also sitting in the range we like to see, sitting at about 2. But if we have a closer look at this pillar, we can see that over the past 12 trailing months, they increased their long-term liabilities by 87.85%. So that is something I will keep my eye on. But now let's have a look at the company's growth. We can see that their net income has been growing at a rate of 57.35% yearly over the past 5 years. Their revenue has been growing at 16% yearly, and their free cash flow has been growing at 17.65% yearly. Now, if we have a closer look at these three pillars, we can see that the revenue grew from 22.5 billion in 2019 to 35.8 billion in 23, so that's great growth in the revenue sector. The net income grew from 2.7 billion in 2019 to 14 billion in 2023, and the free cash flow grew from 9.2 billion in 2019 to 17.6 billion in 2023. So the free cash flow Broadcom generates is higher than the net income that they generate, and that is something I love to see, as the free cash flow is essentially the money the company has left over and is used for share buybacks, paying off debt, paying out dividends, and investing back into the business, while the net income is essentially just a measuring metric. Now, jumping back to the 9-pillar analysis, we already know that Broadcom has great growth, but now let's have a look at their 5-year PE ratio and their price to free cash flow. So first, jumping to the PE ratio, we can see that over the past 5 years it has been sitting at 32.29, but if we have a closer look, we can see that currently it is sitting at $155.60, which means that investors are paying $155 for one single dollar of the company's earnings, which is much higher than what they would pay for an average company's dollar of earnings. Now, something I do want to point out is if we have a look below, we can see that the P ratio was nice and low from 2021 to 2023. And if we jump to Seeking Alpha and compare Broadcom's PE ratio to their price, we can see that between 2022 to about 2023, the PE ratio was sitting at the values or around the values we would like to see. And that's when the price would be considered fairly valued compared to the company's earnings. But from the second half of 2023, the price started irrationally rising and therefore dragging the PE ratio up with it. And currently the PE ratio is extremely high along with the price. What we would like to see that would tell us that the company is fairly valued is for the PE ratio to stay at around 22.5 while the price goes up. Now, for those of you who don't know, I have partnered with Seeking Alpha. I use Seeking Alpha to do the research on the companies I want to add to my portfolio. And so if you want to check out Seeking Alpha, make sure to use the discount link in the description. But now let's jump back to the analysis and have a look at the price to free cash flow of the company, which is currently sitting at 43.33, not as high as the price to earnings ratio, but it is still too high for my taste, as Broadcom is trading twice as expensive as any other average company compared to their free cash flow. Now let's have a look at the company's shares outstanding. Now normally we would like a company to be decreasing their shares outstanding, as that would increase the value of the leftover shares outstanding, but Broadcom has been increasing their shares outstanding at a rate of 2.10% yearly. But if we have a closer look, we can see that the biggest increase happened in the past 12 trailing months. Broadcom increased their shares outstanding by 8.5%, and this is something I actually very much like, as Broadcom is trading at extremely high values compared to their earnings and compared to what they have been trading in the past. And so they are using this opportunity to sell out shares and generate the free cash flow, as it would not make sense for them to buy back shares while they are trading at such high values. And finally, looking at their consecutive dividend growth, sitting at 13.49% yearly over the past 5 years on average, and having a closer look, we can see that indeed the dividend growth has been very consecutive over the past 5 years. So summing up the 9-pillar analysis, we see that Broadcom has great growth in their revenue, free cash flow and net income. They have good profit margin, they are doing the right thing with their shares, they have good consecutive dividend growth and decently low long-term liabilities. But the one thing I hate about Broadcom is their extremely high price to earnings and their high price to free cash flow, and that is the one reason why I wouldn't add this company to my portfolio. But now let's calculate Broadcom's intrinsic value, first using the Graham's formula revised. And here we plug in the 5-year earnings growth estimate at 27.18% yearly and get an intrinsic value of $118.89, which is 51% lower than the current trading price of the company. Now for the discounted cash flow model, we plug in the free cash flow over the past 5 years and calculate an average growth rate of 17.65%. Now for the next 10 years plus, I predict a growth rate of 14.7% and calculate the future free cash flow. I then plug in a discount rate at 8.5% and calculate the present value of that future free cash flow and get an intrinsic value of $150.23, which is still lower than the current trading price. Now in the multiples valuation, Broadcom will get completely beaten up because we will compare its P ratio to its competitors' P ratios, and as we can see, the competitors' P ratios are much lower than Broadcom's P ratio. So when we average these four out and multiply by the earnings per share of Broadcom, we get an intrinsic value of $28.45, which is fairly pathetic. Now moving to the final valuation model, the dividend discount model, where we plug in the dividend payouts over the past 5 years and calculate an average growth rate of 14.24%. Now as I do want to be a little conservative, I project a growth rate of 9% into the future, which is higher than our discount rate, and therefore our intrinsic value comes out negative. And so we have to use our alternative model, where we get an intrinsic value of $179.76, which is about $1 higher than the current trading price. Now finally, we will average out the 4 valuation models and get an intrinsic value of $119.33. Now if I was to remove the multiples valuation, the intrinsic value would come out to $149.63, which is still 16% lower than the current trading price of the company. And so yes, Broadcom has very nice growth, and compared to the 9-pillar analysis, they are looking as a very decent company, but they are just completely overvalued compared to their earnings and compared to their free cash flow. And we can also see this when we look at the valuation models. So I personally really wouldn't recommend buying Broadcom at its current trading price. And with that, if you did enjoy the video, make sure to leave a like and subscribe, as it really helps me out.